Well, let's get going here. Well, thanks everybody, and thanks Anka, thanks David for inviting me to another one of these Synergy Trader specials. So I really love these because this is where a lot of really great information comes together, and hopefully I can earn that right in the next 55 minutes for you guys. So before we get going here, I'm just going to throw this up here, but we're not going to be talking about any live trades except for you guys. So don't worry about that. Some of you may or may not know who I am. So again, my name is Doc Severson. I've been in the business since 2005, so that's 15 straight years. Been trading since 96. The current services that I run are ReadySet.trade and ReadySetCrypto.com. You may have heard my name if you were part of the Options MD course, TheoTrade. I've been involved with Doc's trading tools, and my original service way back when was Options Linebacker. And my specialties are fractal price analysis, which is another way of saying multiple time frame analysis, looking at a lot of things from different angles. I've been trading options and futures since that time, and out of necessity, what I found was that I had to learn about the human mind and the tricks that it plays on you. And this is why I wrote my first book, which was Hacking the Holy Grail, here, The Trader's Guide to Cracking the Code of Profitability. And earlier this year, I came out with Fractal Energy Trading, which is my new book, which is also available on Amazon. So in essence, I'm going to giving you guys a Cliff's Notes of that book here today and about the program that we have. All right, my purpose today, what I hope to accomplish, and I don't think I have I don't have access to the chat room here. So if you guys do have any questions, please let me know at the end of the presentation. I'll find that chat room and I'll look for your questions. So I've been trading the live markets every day since 2004. I've made every mistake that you can possibly make. So what I'm sharing with you guys today is with the hope that you don't have to go through the same path. And I went through the same journey that everybody does with price discovery, finding out what's going on with the price. And I found that many things don't work for very long before somebody comes out with the new thing. Oh, here's the new thing that's out there. And so you feel like you just wasted a bunch of money spending it on something that doesn't work anymore in the market. And I think we've all been through that. So I went back to the basics. I honed my approach over a number of years, and I've come out with what I think is the simplest possible, most elemental way that will never change, depending on what market that you trade or what time frame or anything. Nothing will change that. So my purpose today is to help you understand how much you already know about what I'm going to talk about today. So I analogize everything, and I think that you'll recognize a lot of this. And, oh, by the way, I'll get to my favorite indicator before the session is up. Okay, so ready, set, let's get going here. And in true engineering fashion, what I have to do is I have to start off by saying, like, what is the problem? What is it that we're trying to accomplish here? And I did find the chat room. There we go. So we're not going to fix something unless we know what's broken. So let's identify what is broken with today's retail traders. So what is the problem that we need to fix? Well, it's accurate charting and price discovery, and that leads to trading edge. The problem here is our own embedded human nature ensures that we start this process in the wrong way. We have to dig ourselves out of a hole. Find me somebody that has not done that before. So how we all start with human analysis, and unless you're lucky enough to snag a job on the street, we all start in front of screens in the retail space. And what you find is that humans are herd animals. We feel strength in numbers. This is my favorite thing to do. And this is killing me right now that I can't go to a football game and, go follow my team this year. This is, it's insane, but it is what it is. Humans are herd animals, and it's in our nature to go with the crowd. No one wants to feel like they missed out. And this is why FOMO is such a big thing. So we're used to social logic, right? Over the past, say, 25 years or so, if you want to learn something, if you want to find out let's see, what ninja sword that you need to buy, you can just log on to Amazon and search on ninja sword, and you can search and sort by the number of stars that it has based on 412 ratings or 146 answered questions about ninja swords. So you can basically socialize your decisions. You don't have to be the first one out there to take a risk on buying something. You can let somebody else buy it first and then simply, ride on their coattails in terms of everybody else's experience with that. So this drastically simplifies the process for us. Or if you're looking for breakfast, and you can find out that number 3 on the list in Yelp is the Bacon Bros. And it's quite easy these days to find somewhere to eat, depending on where you are, based on the number of stars. Again, we're socializing that decision. We don't have to take the initial risk of finding out if that place is any good or not. So this all works really, really well. And I'm one of those people that partake of this, right? I use this on Amazon or Yelp or just about anything else that you can use to cut the time of day in these decisions. So we're used to this, but the problem is that when everybody gets into investing, and I'm seeing this a lot with the Robinhood crowd that are coming on board these days, it's like, okay, this all looks fun, but I don't know what I'm doing. So what's my first step? Well, I'm going to Google it, or I'm going to go onto Twitter and look for people that know what they're doing, or I'm going to find a Discord room and join that Discord room with people that think that they know what they're doing. And if you haven't experienced this yet, you soon will, because it's an absolute mess. You just don't know who to believe or what to do. And generally what I find is that most people, this looks like a lot of fun, and this worked all that really, really well when they were living in the basement playing Xbox with their buddies on Discord, but this doesn't work all that well in the real world of investing. The problem is that we become part of the crowd, and that's a bad thing when you're investing. So you become just another fish with the sharks floating around. And what you're going to find is that this does not work if you haven't figured this out already. Or if you're having troubles right now, this is probably one of the causes of that, is that you're allowing yourself to be socially invested. And so a lot of people will turn to the media next. After they get through with the social media, they turn over to the regular media. They say, okay, all right, I surrender. I'm going to just sit there and follow CNBC during the day, or watch Market Watch, or just, Fox Business, or whatever it is. And the problem is that once again, you're getting played. I don't know if you guys know the story behind this, and everybody should study this, but Bill Ackman came on CNBC on March 18th. This was 5 days before the bottom of the last bear that we just went through, the pandemic bear. And basically, he came onto that show and was dead short, $2.6 million dead short, and gave the performance of a lifetime. Now, there was nothing illegal in what he did, but he and CNBC basically played the market, gave the performance of a lifetime. The market flipped out that day. If you look at the candle on March 18th, you'll see that there's a direct correlation to when Ackman was speaking, and the market just took a dump that day and continued lower for the next 5 days. Well, guess what? He covered 5 days later on the 23rd. And as of the last count, I don't know where he is right now, but I think it's worth something like 27 billion. So like 100 to 1 return on something like that. That's just unheard of. And this is all due to the way the investing media works these days. It's like, it's not your friend. They're just there to try to get eyeballs and clicks from clickbait. They don't really care about serving you, the retail investor. So once we get sick of that, which is pretty soon, so we say, look, I just need somebody that can sit down with me. And, it's so frustrating for the retail investor because you don't know who to believe, and you're looking for a guru, and it feels like everybody's trying to take advantage of you. So that's the problem. This is how we get started. And I'm assuming that journey is similar to you. If you're here listening to this, if you've taken out time out of your schedule on a Monday to learn about new indicators. So you're finding your way. So ultimately, after many serial disappointments, those that make it, and I'm assuming those of you on this call today, finally figure out that you need to adopt your own plan. So by this time, hopefully, you know what it is that you're trading. You've stopped trying to be a jack of all trades and a master of none. You've stopped looking around for everything to trade. You don't trade 16 different individual markets. You're just down to a couple, and you know what it is that you do. You've got focus. So that's very, very important. You also have a plan and are treating this like a business and not just an expensive hobby like the Robinhood crew. Now, price discovery, this is where we get into a lot of different opinions here. Price discovery for the pros used to be these guys in the pits, and price discovery is right in front of your face. I mean, you can hear it, you can even smell it in terms of what's happening with the crowd. They were literally the reason why markets moved. And a lot of these are moving off the floor and upstairs, right? So today's challenge with price discovery is everybody's working by themselves. And this is hard. I can't imagine a harder business to break into than working by yourself. And this is, again, why so many people move towards the social end of investing, because you need to feel like you're part of something. But again, like I said a couple of minutes ago, that's only going to lead you down the wrong path. So you've got to find a way to get this to work for you. That's today's challenge with price discovery. So here's what most people do when they do this. And I can't tell you how many charts that I've been, but when we start down this road with using charts for price discovery, what we think is that more is better. More is better. So we start with price only, right? So we start with a basic naked price chart and we say, well, that's not good enough. We can't make any decisions on that. So we got to have some moving averages on here to figure out what our trend is. And we'll add the 50-day and the 200-day. And then, of course, everybody knows that unless you have a MACD on your chart, it's not a real chart. You can't know what you're doing if you don't have a MACD on your chart. Being facetious here if you can't tell. So therefore, we do that. And then, of course, everybody knows you have to have a stochastic on there as well, too. You have to have MACD and stochastics and moving averages. And you're trying to build a system, but it's just not working for you. So what you find is, like, you keep finding new things to throw in there. And everybody says, well, you're not using the RSI. What kind of investor are you? You've got to have the RSI 14 by Wells Wilder. So you add that, and that's still not helping. And so what you're looking around and you come across this guy by the name of John Bollinger, and eureka, the Bollinger Bands. Let's put some volatility readings on our price. Let's put an envelope on the price and find some way to measure volatility. Okay, and that's getting you a little bit better, but it's not good enough. And so what you're going to do is, you saw a great presentation on somebody that put the Keltner channels inside of the Bollinger Bands to be able to create the squeeze, and now you've got a squeeze on there. You can read volatility on volatility and second derivative. But still, that's not making you any money. And so you say, well, wait a minute. I saw this really cool study the other day called the Arun. And so let's add this onto there. And that's still not working. So you add one more thing. You say, well, let's go with another Wells Wilder, the ADX, or the average directional index. And now I've got something. So if everything lines up here from here to here to here to here, all the way up and down, then I can take a trade. And the problem is, you're never going to find anything. Number one. And number two, what you've done is you've compressed the price basically to this unrecognizable little smear up at the top of your screen. You can't see anything. And you've completely obscured everything with all these trailing indicators. So yes, all of these are trailing indicators. They trail behind because they're a sample of the last 14 bars, or in most cases. So you're using old information to try to trade the hard right edge over here. And it's difficult, isn't it? Well, that's because you're putting yourself in the bad spot with all of this. So more is not necessarily better to me. You've twisted yourself into a pretzel with indecision. You'll end up trading not to lose instead of trading to win. And that's a very, very bad place to be. You can't be aggressive. There is no edge when you're trading not to lose, friends. So somewhere along the way, somebody tells you, well, why don't you just read the price? And you push back and you say, well, I can't do that. I can't just trade the price. That's really hard, isn't it? Well, it can be if you attack it from that attitude. But actually, what I found is, over the years, and this is the system that I've created, is that when you use multiple time frames, it's actually quite simple. We're making this so much harder than it needs to be. And so what I hope to do today is to sort of unlock this process for you to show you how simple that it can be. All right, so that's the problem. That's what we need to fix, is this whole sense of analysis. And I've kind of led you down the garden path here, but hopefully you recognize some of these liabilities that we all come to the game with and what we can do about it. So if we're trying to understand price discovery, if we're trying to find that edge, then let's see what kind of rules that we can play. And we're going to find that there's just 4 rules. 4 rules can literally transform your trading. So here's number 1. And I would say write this down. I mean, unless you're going to get the replay later, which of course you're going to do, but this one's worth writing down, and just put these 4 rules on your desk in front of you. Number 1, larger time frames dominate the trend. Okay, that seems to make sense, doesn't it? Why don't we use it? Well, maybe because you haven't been shown how to apply this. So let's talk about this with time frames. So what I find is a lot of newer investors have got all these different time frames in their charts, and they're not quite sure why. Well, somebody told me to put the 10-minute chart on here. Well, I believe in the 60-minute chart. So everybody gets kind of religious and tribalistic about what time frames that they're going to use based on what they're doing, without really understanding exactly what it is or why they're doing that. So we're going to fix that. We need to have context behind what we do. Context is massively important, right? Think about context in the manner of, you're out there swimming in the ocean off the beach in West Palm Beach, and you see the waves coming in, yet you keep on being pulled down the shore and out to sea, and you can't figure out why. Well, it's because there's a riptide going on, and you don't know it, you can't see it, but the riptide is the context in this case. All you see are the waves, but you can't see the larger force that's pulling you out. This is what context is. In this case, context is going to be our larger time frame charts, which is rule number 1. Larger time frame charts dominate the trend. I think through this example, this might give you a visual to show how things actually happen. So what we're going to do is we're going to walk the dog. Now, when you're walking your dog from point A to point B, maybe you'll do it like I do, and I just go from point A to point B and say, I've got a destination to go to. We need to get to our destination to point B. And nothing is going to impede me from that activity, from that goal. But my dog has got a different plan than I do. He's on a leash, and so he's got a certain orbit. And so what he's going to do is he's going to sniff around over here, and then he's going to cross behind me and sniff around over here, and he's going to move up to here. And generally, what you'll find is that the dog is going to take, you know, a route that's probably 5 times longer than the one that I'm picking, but we both arrive at the same destination together, don't we? So this is what happens with larger time frames and smaller time frames, is that a lot of times we'll see these smaller time frames working through all kinds of gyrations, yet you appear at the same destination together. Let me explain. This is the anchor versus the signal. So you can think of this as the anchor chart. The anchor chart is just working in this direction, and this is the larger time frame. However, within that anchor swing, what you don't maybe see is all of these little gyrations that are happening in here through what's called the signal chart. But between these two, which are the more powerful? Of course, the weekly anchor chart. And this is what we lose sight of so many times. When we get shaken out of our trades, when every pullback seems to be, oh my God, here comes the next bear market, we see one red candle and we overreact because we lose focus on the context. So how do we apply rule number 1? We have to understand what larger time frames to add to your signal chart. So signal chart is the chart that you're using to take trades off of. So whatever it is, whether it's a 60-minute chart, it could be a daily chart, what you need is a larger time frame chart that's going to be a multiple of 5 normally to create that anchor chart and to set the context for you. And then while you're doing that, you can understand how to read the trend and swing direction of your anchor chart. Now, this is something that I've got basically tattooed on my forehead: trade in the direction of the anchor chart swing. Everything is so much simpler if we just trade in the direction of the anchor chart swing with this signal chart. So enter that anchor swing on the signal chart. That's rule number 1. Larger time frames dominate the overall trend. So easy to forget, but so powerful if we use it. I told you these were simple. Rule number 2. This is the exact opposite of rule number 1. Reversals start from the inside out and they propagate higher. Why do we care about something like this? Well, reversals are the holy grail of trading. Everybody wants to find reversals because this offers the very best reward to risk for a trade. I mean, those that were able to catch this thing short back in the February timeframe, that is your best reward to risk. I mean, most people were entering short down in this area, not way up here. So catching that reversal at the very beginning, the very genesis of that trend, is so important, and it's so difficult to do, right? But not difficult if we have a structure behind it. So this is where we get into the anchor chart. Well, why don't we just use the anchor chart? Because the anchor chart's more powerful, right? You said that in rule number 1. It's nearly impossible to spot a reversal in time on these large lumbering anchor charts. It's not their job. It's to keep you trading in that direction. However, your signal chart is going to show you when that reverses the soonest. Change always happens from the inside out. So think about how a virus infects a single host cell and then begins to multiply and swamp your immune system. I think we're all experts in that now. A trend reversal starts from the smallest time frames and then progressively propagates higher. Think about change and think about how change happens. If you drive the same car every day and all of a sudden your spouse, like, hasn't driven it for a couple of months, gets in and says, "Whoa, what are you doing, man? Your brakes are terrible." Well, I didn't notice. Well, you don't notice things because the change is so small every day, right? Until something actually breaks, and then you notice it. So change happening at small levels are early warning to possible failure or reversal, which is what we care about here. So change happens at the inside out. So this is where we have to look for signal chart reversals, and it can be quite simple if we just look at the old Dow theory. So what's higher highs, higher lows, higher highs? Lower low, warning signal, lower high, confirmation. It's gone. So that's a top reversal. And we can do the same thing down here with just standard Dow theory, understanding the waves and when this pattern changes. When you go from a lower low to a higher high, higher low, higher high, you've got a change in polarity. It's so simple, but we seem to think it's difficult, and we seem to think that we need indicators to tell us when something's reversed. But indicators are going to be trailing. They're going to be so much slower by the time that MACD turns up, or by the time you get a stochastic cross. You've lost at least 3 candles before that actually happens. Edge is not exactly sitting out on the curb these days, guys. It's like 80% of the market movement is happening in the aftermarket now. But nobody's talking about that. So there's so little meat left on the bone by the time it gets to the cash market. You have to be in early. You got to be in it to win it. You've got to catch those early reversals before they hit the cash market. Reversals propagate higher in time frame. So something starting on the daily chart will eventually propagate to the weekly chart, and then eventually maybe even to the monthly chart. So this is that reversal off the bottom. The weekly chart has to do the same thing in turn. It's got to put in a higher low, higher high as well too. for that to reverse. So the daily chart's so much faster, but what's even faster than that would be the 60-minute chart. So how do we apply rule number 2? Thanks for sticking with me so far. Understand that smaller time frames to use for your signal chart to help you spot changes in trend faster. So it all is going to depend. I mean, if you're trading the NASDAQ futures, for example, I may use a 68.75 tick chart as my anchor chart and use a 275 tick chart as my signal chart to enter. Or perhaps I'm just trading swings and I'm going to look for my weekly chart to be my anchor chart, and I'll look for my signal chart to be the daily chart. Setting up these relationships between anchor and signal chart are important. So reversals come from the inside out and they propagate higher. This is going to be the way that you're going to be able to spot trend changes before they actually happen, because you're going to be able to map it out. It's not about predicting the future. It's telling yourself what to do when that changes. Okay, so those are reversals. That's rule number 2. Reversals start from the inside out and they propagate higher. You guys will like this one. It's really simple. Descending patterns break to the upside and vice versa. This is an extremely simple rule. I see in play every day at every time frame, intraday or larger. So many people discount it, but you can use it to help your own trading. And what you're going to do is look for confluence. This to me is not exactly a signal, but what you'll see is what it goes up goes down. What goes down goes up. What goes up goes down. You can't go up in perpetuity. It's going to go down at some point. And so what we find is that these descending patterns will eventually break to the upside. It happens all the time. We see these waves all the time in every time frame and every market. It's just simple physics, guys. Can't go on forever. So what we can do is we can apply trend lines. Now, a lot of people roll their eyeballs when they hear, oh, no, not another trend line, dude. But I'm just saying, use them as a filter. Normally, trend lines will get broken around the same time that the polarity changes. So don't trade based on the break of the trend line, but based on, hey, it's broken. So now what I need to do is I need to look for the next reversal in trend and enter there. And then you can see that this creates a rising pattern, which will eventually break to the downside. It just goes back and forth all the time. So very, very simple. So how do we apply rule number 3? Obviously, you're going to see more of these intraday versus a swing trade. Eventually, there's going to be a no-doubter break, though, of that trend line. And the cycle will continue. And this, to me, is very important. This should be used as more of a filter than an actual entry and exit signal. It adds confluence to reversal signals. So rule number 3, ascending patterns break to the downside. Descending patterns break to the upside. And it just goes back and forth over and over again. So that's rule number 3. Descending patterns break to the upside, vice versa. Now we're getting to rule number 4. This is going to be a little bit different from you guys, because I'm going to challenge you on some of the things that you think about. So let's get into this topic about overbought and oversold. Somewhere along the way, traders got fed this notion, well, it's overbought or it's oversold. So we quietly go along with this because somebody taught us about this a long time ago. We've never stopped to question whether overbought or oversold really means anything. The problem here is that we're in a world today where there's no limit on money printing. So to me, I think this notion is outdated, obsolete. This was really applied back when markets were much choppier, back in the 50s and 60s, where we got into things like MACD and stochastics. And today, it's a different world. This is not your grandfather's market anymore. So the problem is I see so many people that are out there getting so angry at the market. I mean, raise your hand if you're pissed off at the market right now, because it won't stop going down. Why? Why are you angry when the market's just saying, look, I'm not overbought. I don't care about this overbought. That's something that's a limitation you're putting on yourself. So this is where I just see so many people just losing it over this stuff. And it breaks my heart. Like, let the price do what the price is going to do. It's market does not care about our judgment on what is overbought, overvalued, anything like that. You can throw whatever statistics that you want to at me with today's fundamentals. I think are basically useless, and they have been useless since 2013. Well, actually 2010, when Bernanke stood in front of the microphone at Jackson Hole and said, I'm going to put into place this thing called quantitative easing. And nobody had ever heard of it before. Nobody knew exactly what to think of it. But a few years later, all of a sudden we noticed, wait a minute, okay, we get it now. So I need you to let go of this sort of notion where you think that you can, your logic controls where the market's going to go. It doesn't. Markets move differently today. They run as far as they possibly can until they hit what I call exhaustion. And then they tend to consolidate. Not reverse necessarily, but they'll consolidate and then just repeat this. So it's almost like a stair-stepping thing that you've seen. Markets will go as far as they can, and then they will consolidate in some form until they build up energy again to go on the next move. And sometimes that next move can actually be in the opposite direction. We don't know which way it's going to go, but price will tell us which way it is going based on rule number 2, right? So this range contraction continues until the chart recharges, and then the price moves to range expansion again. The cycle repeats forever. This cycle repeats forever and ever and ever, and it just keeps on going back and forth, back and forth. There is no overbought. There is no oversold. But there is range expansion moving to range contraction. If you start to look at markets in a different way, it's not going to frustrate you anymore. You're not going to feel like you're going against the tide all the time and being on the wrong side of the price based on what some dude told you maybe years ago about overbought and oversold. Markets tend to copy nature and how we interact with nature. And sometimes you have to stop to look at this and see how much the market is an organism after all. Now think about this. If you're going to go summit Mount Everest, you're not going to just say, well, to hell with all this stuff. I'm just going to go run up there. It's only 5 miles after all. I can make 5 miles. That's not going to work. So what typically people have to do is they have to go as far as they can up to the first base camp, and then they have to stay there for like a week and acclimate themselves to that altitude. And from there, once you're ready, okay, I've been here long enough. I can't wait to get out of here. I feel fine. Boom. Up to camp 2, 6,500 meters. Now you're feeling a little tired and you're actually happy that that camp is there because you need about a week to recuperate from that. And then comes camp 3 and then camp 4. And then if you're not a statistic or if you're not a statue on the side of that mountain, you'll summit at some point. Okay. But isn't this exactly how markets work? Don't they do the same exact thing? Go as far as they can, consolidate. Go as far as they can, consolidate. Nobody sprints up the side of a mountain. It's not how things work in nature. It's not how markets work either. So we can see this with expansion and contraction on charts. We see markets going into contraction. Range contraction leads to range expansion and exhaustion. And then we run into range contraction again. And then we run into it's built up energy and then range expansion again. Range contraction, range expansion, range contraction, range expansion. And it just goes back and forth between these two. Now, this is my favorite. This is my favorite indicator here, the choppiness index, which few of you have heard of before. And even some major packages do not have. So I've actually got the code for this for Thinkorswim, for TradeStation. It comes with TradingView. So that's out there. It comes with TrendSpider. I'm not sure if TrendSpider is part of today's event, but it's starting to come out on more and more and more things. And this goes back to an article that I wrote back in 2012, which you may have received as part of today's event. But since that article, I've seen a lot more packages come out with a choppiness index. It's become much more popular since then. And I think it's actually a very, very versatile indicator because unlike something like the squeeze is only going to show you when things are squeezing and are ready to pop. But what the CHOP index does is it shows you when to anticipate exhaustion. And the squeeze won't do that for you. The squeeze nor the ADX will sort of do it, but I don't think it's as responsive. So I'm a big time fan of the CHOP index by E.W. Dreiss. You can Google it and read more about it. Now we can also combine this CHOP index with, the RSI in Laguerre time, which is an awesome tool for intraday trading because it's very quick. So yeah, for all the bashing I just gave indicators a few minutes ago, this one's actually very responsive because it doesn't use a linear time frame. It uses the Laguerre time transform. And for you math majors, you can look that up and tell me what exactly it means. But to me, it just means that it's a heck of a lot more responsive to changes in trend and price movement than any other oscillator that I've seen. And so what we do is we embed the fractal energy indicator or the CHOP index inside of that study. And we also have this one on Thinkorswim. We've got this also for TradingView as well too. So some pretty cool applications for the choppiness index. So something that just seems to be, this pedestrian sort of forgotten indicator to me is the keys to the kingdom because it tells me what the context is of what's going on. There's no other study that I found that gives me as much information about what's going on with price action. When we combine it with price action, this is where the magic comes. And this is where all four rules come together for what we do. So how do we apply rule number 4? Well, using these principles is going to give us an early warning, and this is the important thing here, an early warning. What we want to do is anticipate and get ready for things, right? We don't want to just have these, red and green arrows that tell us what to do because who knows if that character matches the algorithm for that red and green arrow. We want an early warning when a consolidating price chart is about to break out, as well as the exact opposite warning when a trending price chart is about to stall out and rest. I put a calendar spread this morning in the trading room on the S&P 500 today. Why would I do that? Because the S&P is in daily exhaustion right now. It's highly likely over the next 5 days to consolidate, stall out, perhaps even pull back, or it can continue higher, but if it does so, it's highly likely to do so at a very, very glacial pace, very labored pace to the upside. So this is why I put on a non-directional calendar spread. So this also works on every time frame, but the larger the time frame, the more powerful the signal. If something is in weekly exhaustion, I'm going to have some kind of reaction coming up real soon. We might see several weeks of volatile trendless action, but a weekly charged signal might tell us to expect a major break in price. So the CHOP index measures linearity of the current trend. And we use this to determine exhaustion and charged up levels. So range expansion leads to range contraction, back and forth, again and again, forever. Tasty Trade, Jennifer does not have this study that I'm aware of. I think I looked there and I did not see it on Tastyworks. And I don't think they do custom studies. That's rule number 4. Range expansion leads to range contraction and vice versa. So let me give you a couple of trade examples and applications. So we use the fractal energy trading at ReadySet.trade. And this is how we get an 80% win rate with these. Okay, so here's an example. Microsoft Directional. What are we going to do? We're going to put all these rules together. We don't need all of them all the time, but right now what we do is we have an anchor trend. Trade in the direction of the anchor chart swing. This was rule number 1. So Microsoft, I'm looking to go long. Now I move to the next time frame. Do I have enough energy here to support a long? Yes, I do. So that's the green arrow. Now I go down to the signal chart, which is the daily chart in this case. And actually, I think my entry was right around here. I was looking for the breakout from here, and it didn't come immediately. So markets can do whatever they want to, right? I didn't sit there and gnash my teeth and yell at it because it's supposed to break out. It can do whatever it wants to. But in this case, Microsoft eventually broke out 23 calendar days. Again, we're not looking for home runs. This is not like, a 10 bagger or something like that. It's just a vertical spread where we're hitting base hits every day, base hits every day. New York Yankees win all these World Series titles in the past by hitting base hits, not necessarily the home runs that they hit. So an 80% win rate will also give you a great deal of confidence that you're not going to think twice about pulling the trigger on a trade, especially when you know that the risk is contained on the trade. You know exactly how much risk is contained on the trade. That's a Microsoft directional trade. Now, I can also do non-directional. This is what I think is really cool, right? So you can start to see on this, you have range contraction, builds up a lot of energy, and then it breaks out from that range contraction to the upside far enough so you get exhaustion. That's an exhaustion signal. And so I aggressively entered a calendar spread. If you haven't seen a calendar spread before, they look something like this, where there's the zero line, and what you're looking to do is you've got this sort of T plus zero line that you're trying to manage. And so you've got a wide area of profitability for the trade, but they're very, very quick in terms of burning off time value because you're burning those options that are right at the money. So it's a great trade for something like this, for a hit and run, when you get on board and you're looking for a certain amount of time value decay from that short option. And in this case, it came in 7 days, 47% return on risk for the trade, which is outstanding, and $245 profit per contract, which is actually a little light for that strategy. So other ones, but what I saw here was that the energy was building up again. So part of trading is risk management. Yes, it's not just your entries. Anybody can show you how to enter a trade, but understanding when to get out of Dodge is also equally, I would say even more important than your entries. And for those of you that understand, I think you'll agree with me, is that exits are much more important than entries. Okay, so that was a calendar spread. Now, we also do a lot of these zero DTE, or 0 days to expiration trades. Now, this one, I didn't necessarily have to use energies or anything like that. All I'm doing is I'm just reading price. I'm just reading these trends. Okay, we move into an uptrend, and then all of a sudden we move to a downtrend. We reverse, and it stays within the opening range. So this is our opening range. Right there, the first 30 minutes of the S&Ps. And all we're doing is we're using a calendar spread in the same manner. We're just looking for it to stay within that range, within that bump there. And then we're out of this in 22.5 minutes with a $100 profit contract, 37% return on risk. Again, base hits, get in, get your fair share, get out, win, repeat. This is what trading's about. It's not about hitting home runs, guys. It's not about posting on, hey, look how much I just made on this trade, okay? If that's the way, that only works with the market working one direction. We try to be able to trade with whether the market's going up, down, or sideways. So this is what we do in ReadySet.trade, is everything that we trade, we journal, and we put it down, and we throw our statistics out there with our members, or anybody else for that matter. I mean, we try to be as transparent as possible. What we're doing is not rocket surgery, but we're putting things together in a manner that few other people are. It's a very consistent approach. It's very easy to learn. So those are just some examples of what we've done recently. A lot more of our trades have been the 0 DTE variant because, and again, this is what nobody's talking about, is that 80% of the market movement is happening in the after hours, 80%, and then you're fighting on these scraps during the day, and that's perfect for a range bound 0 days to expiration trade. So those are some examples. So what do we do here? This is the magic formula. Told you what I was going to tell you. I told you, and now I'm going to tell you what I just told you. let's put it all together. A lot of you will be overwhelmed, like, oh man, 4 rules, that's way too much. What do I do? How do I get started doing this? Well, don't do everything all at once. You'll confuse yourself. Anytime you add something new to your repertoire, you're gonna just do it incrementally. So again, don't forget what the problem is. What not to do. Don't socialize your decisions. Don't go on to Twitter feeds and don't go on to Discord rooms and say, hey guys, I just funded a $1,000 Robinhood account. What should I trade? Oh boy. It's like the old flounder line. Hey, you guys playing cards? And then we usually gravitate towards charts as price discovery is easier to read visually, right? Everybody does this, but they just as quickly slow their progress by piling on a whole bunch of crap in your charts. Is just not going to tell you what's going on. You're going to be trading to lose or trading not to lose instead of trading to win. And so a lot of you are still using these outdated concepts of overbought and oversold. Get away from that. Move into the new paradigm. So remember, rule number 1, larger time frames dominate the price trend. Write these down, put them on your desk, start applying them tomorrow. Choose an anchor chart time frame. Understand the anchor trend and swing direction. Trade in the direction of the anchor chart swing. Just keep saying that to yourself. Trade in the direction of the anchor chart swing. Don't try to pick the tops and the bottoms. Don't try to catch a falling knife or rising knife. Just trade in the direction of the anchor chart swing. Your performance will improve immediately. Reversals start from the inside out and they propagate higher in time frame. This is rule number 2. Reversals in trend will start at the signal chart or something smaller than that, and they'll start to propagate higher in time frame on you. So change to market character begins from the inside. If you want to be an expert on catching reversals, understand how to set up a signal chart and look for that price action reversal. That's the very fastest way to get on board a brand new trend. Then we get rule number 3, which is real simple. Ascending patterns break to the downside, descending patterns break to the upside. It's just a filter, guys. It's not meant to be anything fancy. Upside reversals tend to go hand in hand with the descending trend line breaks and vice versa though. So use it in conjunction with other skills. And then rule number 4, range expansion leads to range contraction. And anybody that's followed me for any length of time is probably sick and tired of me saying this, but it's sort of like, like a rhyme, like range expansion leads to range contraction leads to range expansion. But think about how often that happens in life, right? In nature, things expand, things contract. When you breathe, what do? You expand and contract. This is all we do. If you want to climb a mountain, you run as far as you can. You expand the range until you're gasping for breath and you're holding your sides. You're going to range contract. You're going to sit down and rest for a minute, and then you're going to resume the assault. This is the way things move. The cycle never ends, guys. Don't fight nature. So this is how to put it all together. So to summarize, it's my belief that everybody needs to shift to price and energy-based analysis, ditch the old paradigm that no longer works. And you might be looking at this and say, well, Doc, that sounds great, but it took you, how many years to come up with that? And, I don't have that much time, and, I need to make money starting tomorrow. So how can you start? Well, consider joining our community. We have a community of traders who seek high probability, low risk trades. There's no home run hitters here. And we seek to make $100 a day. We're looking for just a very simple approach towards the market. We're not looking to, brag on Twitter. Look, we made $80,000 yesterday, things like that. Come on, that's just not sustainable. Let's do things that are reasonable. Let's do things that are repetitive and repeatable. So we provide the structure and guidance to show how to quickly come up to speed on fractal energy trading, adopt high probability strategies, plus all of the other intangibles that are necessary for success, like the business planning and how to be professional in your approach. We set up things through systems. Goals are for people who care about winning once, but systems are for people who care about winning repeatedly. So things that we do at ReadySet.trade. Well, in our service, we have a live daily trading room. We're on there 8 times a week. We have 5 times a week daily newsletter. We have a live online community of great people. We have live trade notifications and adjustments. We have courses like the $100 a day course and, oh, by the way, fractal energy trading, as well as other strategy courses too. And we do everything in, really top level, the best technology that we can get our hands on to be able to communicate things, and actually moving to a brand new service this week as well too. So if you want to join us though, instead of joining the service, what you could do is you could just grab the class, man. So instead of $299, where if you go out to the street, this is going to be priced at $300, you can get on board today for about 99 bucks. So this is our course, the 4 rules to radically improve your trades, fractal energy trading, to be able to profit in any market, any time frame. You can use this whether you're a day trader, swing trader, long-term buy and hold, Forex, futures, it does not matter. Even crypto, price action is price action. So it's a one-time payment, that's it. Or you're welcome to join us. Welcome to join us through our course. If you're curious as to what's in the course, all aspects of fractal energy trade, this is actually a really deep, I don't want to intimidate you, but this is some deep stuff. This is not a half an hour in and out kind of thing. This is something where you're going to fundamentally transform how you look at markets through multiple time frame analysis by understanding how to read price action. And oh yeah, learning how to use the choppiness index to be able to understand range contraction and range expansion. So everything, we do it through video PDF, as well as you get access to moi, yours truly. So if you're curious, what's that link again? It is ReadySet.trade/4. So let me post this into the room. If you want that discount to get that course, or, yeah, let me post it in there. There we go. Boom. And with that, my friends, I've finished my material. And it looks like I'm just about on time. And so I got about 2 minutes here to answer questions for you. Yeah, so Jennifer, I don't believe that Tastyworks does that study. Don't believe that they do that. Does this indicator work for Forex? Absolutely. How can we get or set up the choppiness signal on the Thinkorswim platform? Just email me. My email's right on the last slide here, doc@ReadySet.trade. You're welcome, Lexus. Lexus is one of our members. Awesome guy. Let's see. Is this like the, yeah, it's similar to that. It's like if you join the room, you get all information for the same monthly subscription fee. With descending triangles breaking to the upside, does it matter if it's an uptrend or downtrend? Yeah, the context of it does depend on what's going on. You have to understand where the understanding how to read the wicks is important there. Do I use the expected move to find the options pricing for my spreads? Yes, I can. Things like the expected move is going to affect, the expected move is how we set the width on our iron butterflies, for example, when we trade the 0 DTE. So we use the expected move for everything. So I'm kind of a mutt, because not only do I use technical analysis, but I also use the statistical analysis that options provide. So whether it's IV, understanding the skew, understanding the expected move, what is the market telling us about the forward move, things like that. I'll use anything I can get my hands on to get edge. Okay. Is the course different from your recent book? No, the course really is in line with the recent book. TD Ameritrade does not have the study, but I do have the code to it. No, I don't charge people for the code. I mean, you're welcome to it if you want it. Do I provide real-time option signals based on these indicators? We do a couple of things. We do provide some signals that go straight into the room for people to take if they want them. But anything that I actually enter and trade, I call out in the room and I provide a signal for that. So Jim, when you say $100 a day, how much money is at risk for that target income? Typically for $100, we're looking for, like for example, like for the zero DTE trades, we're maybe risking $300 to make 100. So typical iron butterfly, I'm risking about $300 for those to make 100. But again, it's a speed thing. So it's not like a futures thing where it's a 1-to-5 reward to risk ratio. Okay, last question. Does choppiness index help in setting up weekly call options? I'm not sure what your weekly call options are. I'm not sure what your strategy is, but to me, fractal energy allows me to understand what's actually happening, not necessarily predicting the future. Nobody can predict the future, but if you can get a frame of reference for how to act going forward, in other words, if the price breaks out above a certain box, all right, if the price breaks out about this box, what are you going to do? If the price breaks down from this box, what are you going to do? You know, understanding the different implications where price goes and being prepared for that, I think, is the most important thing that you can do. Okay, super. Well, Dave and Anka, I'm going to turn it back to you guys and